Saurabh Basrar. He runs a PMS at Banyan Capital. He holds a CFA charter holder from CFA Institute USA. He has got over 20 years of experience in the financial markets. He has been an investor since 15 years, last 15 years. He mentors investors, including family offices, on investing framework, which we would be discussing today. And all of you must be knowing him. He has co-authored the bestseller book Masterclass with Super Investors. So we'll be discussing about that also. And previously, he used to work with Fidelity Investments and AT Kearney. So a very warm welcome, Saurabh. Anything on your introduction would request you to add to that, and would appreciate if you tell our attendees like how it all started for you, any background on investing from family side, or it was you who started as a first member who developed great interest in the financial markets in the family.
Yeah, okay. So, yeah, no background from the family. Largely come from a family wherein parents were working, and started with sort of work for a few years, and then always was interested in sort of doing stuff. So, investing was something sort of that had a lot of appeal. So, a quick background is I born and brought up in Delhi, largely went to school in Delhi, went to SRCC, did my CA, worked for a few years with Citibank, AD Kearney, Fidelity, and then sort of during that time also finished my CFA and then sort of got into equity markets. So, and sort of been there for close to about 15 years now. So that's broadly the background, and yeah, I have. I mean, it's been a learning experience. Still, is a learning experience. While it is easy to say that you can learn a lot, but it is very very difficult to actually do it without making the mistakes yourself. So it's like a conundrum here that sort of we wrote a book which sort of captures a lot of learnings, but at the same time I can sort of appreciate that a lot of learning for me also came from making a lot of stupid mistakes or something, or largely means in terms of if I'd maybe known a lot of things earlier in the last 10-15 years, it would have been much easier. But anyways, that's life. So in terms of so I think what I can give you a background about how the book came about, and in terms of largely what has been the key takeaways or sort of my understanding, some of the I can share some experience around that, and then I guess it'll be good to maybe just have a sort of a Q&A, sort of I can answer any questions or anything sort of which people have. That works?
Yeah, totally works.
Sure. So, Masterclass with Super Investors essentially wasn't planned as a book. So, the idea which came about was that since me and Vishal had been investing in the markets for sort of close to about 7-8 years ourselves, but then we realized that there are people who have done phenomenally better. So, what is it that maybe those group of people would have done, sort of, which we are not doing, or means is there a method around it, or it is it can't be random actually, but what is it, right? So, in terms of learning that, because again, there's no school that you can go to or take a course to learn those kind of things. So the whole thing started more like going to meet people and understanding sort of from them what they have done, how they have done, sort of the thought process, right? The framework, thought process, the background. So we did spend a lot of time doing that, but once we did that, and obviously when we were doing it, we were also sort of at least taking notes, compiling it, right, for our own thing. But then we realized that there's so much out there that sort of which we did not know, and obviously because we knew a lot of other investors and all, we also knew they also don't know. I mean, in terms of majority of the people would not know, and these are like amazing learnings. And then we thought it makes sense to actually sort of compile and put it together as a book. We thought another thing was we thought it'll take us a few months at most, let's say 8-9 months to do it in terms of the time, but actually it ended up taking close to 2-3 years because obviously in terms of compiling everything together, meeting people in sort of different geographies. So that was one. And then when you put it in a book format in terms of editing, in terms of, so we had to cut out a lot of things. We had to sort of summarize a lot of things. So all those actually get it edited, sort of. So all of that took a lot of time, but quite happy with sort of how it turned out. And I think it's something like which I read today also from scratch. I still get a different perspective. So I guess thanks to all the people who gave the time for this to happen. So this is largely sort of about the background of the book, and sort of any questions on sort of this, and then I can sort of talk about some sort of.
Yes, Saurabh. So, Saurabh, like networking appears to be an easy task, but when you talk about big names in the industry, so it's approaching them might be possibility in some events or so, but directly approaching them is a Herculean task in itself. So, how had been your experience like reaching out to them and convincing them so as to share like decadal experiences with you?
So, yeah, good question. See, in terms of people convincing them, see, some people are private, they sort of, so obviously we approached a lot of the people also, and I won't take names. They refused, and maybe means in terms of given their privacy and all, which is fine. And some people are open. So I think it's a very personal thing. Someone who does not want to sort of come out, and they still do their bit in terms of not that they don't do it in terms of service to society. Maybe they do it in some other way, but maybe it's a personal decision for them not to sort of come out like this. So we met a lot of people, some people who are in the book, some people who are not in the book. And so largely, I think it was fine. Obviously, means effort is involved because you have to get to them. Some people sort of you get some references. Some people you know. Some people you sort of, let's say, sort of do a cold call or write a mail about the background what you're doing. But I think largely when they get to know that what you're doing with the aim and sort of also what the peer set is, so that also helps.
Right, Saurabh. So, Saurabh, when you started doing investing and gradually over a period of time, as you were speaking, that you made a lot of mistakes. So everybody has their side of evolution as an investor. So how had been your like initial years, and if we compare those years with today's time, like what all changes you have in your framework and how you go about it?
So again, it depends. I think the answer to this question depends on sort of who the listener would be. So for someone, let's say, who's just starting out into investing, at that stage, I think the biggest learning for me, or learning in the sense, it's not a learning in the sense I did not know, but maybe didn't pay as much heed to it. Now knowing what I know, I think it's important, very important, is that even if you start very small, it does make a lot of difference over a period of time. So I think I don't know, but I don't want to generalize it, but I think I still that we underestimate the time element and sort of give too much importance to short term there. It is just human nature. So let's say when you start out on a job, let's say you don't have much money, so even saving 5-10,000 rupees at that point of time might just seem pointless, right? कि 5,000 बचा लिए, 10,000 बचा लिए एक साल में, 60,000 बच जाएंगे, मतलब doesn't change life, doesn't change anything, right? So why do it? And even if you double triple it again, it doesn't change anything, right? It's like here or there. But I think it's more about the discipline, and over time it, and if you are disciplined, continue with it, it does make a lot of difference. So I think that's one piece, that the way I looked at things earlier and now, I think even if you start small, because again, whether you start small or whatever amount is something also dependent on your own circumstances, background, and everything. But starting small also over a period of time does give you a huge edge, because you start early, you do those mistakes earlier, you get those learnings earlier, and obviously means if you are reasonably not even good, average, or let's say because you're learning, so your compounding sort of grows much more over a period of time.
Right. So Vishal also has co-authored the book. So what is what was it equal contribution or some sense of the work was divided or you guys used to interview these stalwarts together or how was it?
So the good part was both me and Vishal are practitioners like investing for a long time. So a lot of in the book comes from personal experience, the questions, even the counter questions, and in terms of editing, which is relevant to actual process of investing. So the work was divided, but largely I think we ended up doing a lot of stuff together twice because sort of it helped to improve the whole thing more. So that way, so basically, it's like earlier when you look at any other book, they talk about stocks, they talk about industries, but without having numbers there. So I can talk about something, but let's say there is no number, or basically you don't have the data, then it's a very different thing compared to having the whole data set in front of you and talking about it. So basically, the relevance in terms of understanding how the numbers moved, what happened, it becomes much, much, much easier and relatable.
So, you must have interviewed many other people. So, how had been making a choice of shortlisting those 11 names?
So it was a mix in terms of we wanted to get some institutional investors, a good set of people who have invested their own money and done well over a period. So I think that was largely the call, and also in terms of there were some people sort of who weren't at that point of time open in terms of coming out. So basically, that was largely in terms of how the decision making went.
So, Saurabh, let's talk a bit about your investment framework. So, starting from idea generation to investing in particular company, how it goes for you?
Okay, so in fact, I'll just take a step back and say when I started, the whole thought about investing was that there are great opportunities in the mid and small cap space because that space is not something in which sort of, let's say, you have institutional focus. So let's say the opportunities to get better risk rewards or ideas which are not, or companies which are sort of not in the fancy are more, and you can make sort of higher returns over a period of time. While that is true, but at the same time it comes with a lot of caveats, right? It's not as simple. So sort of obviously that's a big learning over the years. Now, in terms of my framework, it has evolved over a period of time from a simple framework in terms of buying cheap companies or sort of being value focused. Again, value I think is a misused term a lot. So, being value focused, buying cheap compared to the intrinsic value and making money on that, right? While it sounds good, but again, it's a lot of theory versus how practically market or investing works. So, for me, I look at two broad areas, means in terms of for interest to me. One is companies, obviously means the basic benchmarks are the company, the business I should understand, the company should be relatively well run in terms of how it is making money. I should understand that. The leverage, the ROEs, the growth profile, sort of how management has run the business historically now, those kind of things, right? Basic checks. Beyond that, the two major things are one, the growth runway and sort of higher growth, because higher growth will translate into bigger business and higher valuation. Oh, so not even higher valuation, higher value of the business. And so that is one part. And the second part would be wherein there is deep value with some sort of a catalyst. Right. So basically, these would be the two broad areas that I am generally interested in.
So I mean, we have a problem of plenty these days because across social media and when you have a good network, even there also you get ideas on regular basis. So, what do you do so as to filter out what is worth looking at and what is a no upfront? So, how you decide on that?
See, again, investing in a way is very similar or close to spirituality because in investing, And as in life, there is no certainty. Okay. So investing again is like betting based on probabilities or whatever you think the probabilities are, right? Based on risk reward, based on what you think. And the future is uncertain, so there is no guarantee about anything. So it comes down to how each person's individual temperament is. Again, there is no right or wrong way to invest. So what works for me might not work for you, or what works for you might not work for me. It is also a function of each person's, let's say, goal, let's say, in terms of their positioning, in terms of the kind of net worth they would have, the kind of sort of economic environment they are in, right? Background, so on and so forth. So what I'm talking about is, let's say, what works for me, I can say in my context, but again, everyone has to see that given their temperament, what will work for them, and accordingly sort of build on that. Now obviously, to know what works for you, maybe you have to do a lot of trial and error and figure out how your temperament matches with your framework. Because someone, let's say, who is very jumpy in terms of from a short term perspective, gets in and out. Now, his temperament is not matching to long term investing, right? Either he matches it, but otherwise he cannot do long term investing. And someone who does not want to look at things on a daily basis starts doing trading or sort of doing for very short term. Again, there's a difference between sort of, there's a mismatch between temperament and what they are doing. So these are extreme examples, but I guess you get the drift that obviously there's a lot of things in between.
So like when coming, if I talk about portfolio construction, so how you construct your portfolio and how you, when it comes to asset allocation, so is it like all equity or some sort of diversification on that front also?
No, it's largely equity, and till the time it's not invested, maybe it could be in sort of liquid funds or debt funds largely. And from a portfolio construction standpoint, it's relatively concentrated. So it could range anywhere between, let's say, 7, 8 to 12, 13 companies, and even the top 3, 4 companies could have a very high allocation for me. That's personally, and purely from public money, or let's say PMS standpoint, it will be relatively again concentrated, maybe anywhere between 10 to 15 names, position sizing ranging from a minimum of, let's say, 3 4% to up to 15%. But let's say 4 to 5% will be the minimum. So sort of maybe 3%, 4% could be a starting position, which I would want to increase to 7 odd percent at the minimum. So it's large, I would say, concentrated sort of investing.
Investing. So before coming to Kaushik, one quick question, Saurabh. So is it like you build your position, or is it like if you are convinced, so you do a lump sum investment in that company in one go?
Again, depends. So if I like something very much and I sort of see, I don't see much of a downside risk, and let's say the risk reward is favorable, one could do it all at once. Or let's say if one thinks, let's say the stock is a bit extended, and in that case, maybe you can do it in 2 or 3 sort of tranches. So again, it'll be a factor of in terms of at that point of time how things are.
Right. So Kaushik, you can ask your questions, please.
Thanks, Prince, for the opportunity. Hi, sir. My question is basically, I have read your book more than like 4, 5 times. Whenever I feel down, that's a book that catches my hand. I just wanted to understand, as an author, you have taken an interview for them, and like you have been interacting with them, and then have written this book. So, can you just describe each and every the person that you have, and what is the key learning that you have got it from each and every person? If possible, one single answer for the all the authors and then each and individual veterans in the book.
See, it's very difficult because there are sort of almost like 100-page plus chapter on each person. So to sort of condense it into one single line, or maybe even a 2, 3 lines, will not do justice, because it's just, I don't know how to do it, right? Because a lot of thing overlaps. People think in different ways, but also in similar ways in some instances, right? So I think it's more nuanced. It's not as simple as sort of putting it in one line. And the second part, in terms of what has been the learnings, or let's say, I think that largely has been captured reasonably well in the key takeaways, and that is across all those investors together. Because see, so largely, let's say if I take an example, the takeaway that being optimist on the Indian economy. So you have to be an optimist. You are if you are sort of want to be a good investor, because major money is made on the long side, not sort of shorting. So you have to be an optimist. If you are not an optimist, it's very difficult, because optimism is inherently needed to be able to, one, invest for the long term, and secondly, to be able to ride out sort of challenging periods. So, and that is true, I think, across everyone. Means until unless you're optimist, I personally, I also agree that it's very, very, very difficult to make money over a period of time.
Got it, sir.
If you have any other question, you can go ahead. No issues.
So my second part of the question is that like holding long is something makes the highest point of return. That's true, but what makes that conviction to be built up? Is it while we invest our money, the conviction has been started, or the process starts when we are actually after buying every analysis that we do and we keep on traveling with the company? How this one and any person has spoken about this and what any examples that you can share?
So you're asking, let's say, once you buy, what gives you conviction to hold the company or the
Is that the
investment? Is
question?
that the question?
Yes, yes. That's a part of the question. Yes.
See, first, when you buy anything, I think you're buying based on sort of your understanding in terms of what you think, right? Obviously, if someone's buying, he's assuming that the thing will do well based on whatever his thesis would be. So at the outset, that is just a thesis, right? So it's like, so from a probability standpoint, if you play cards or poker, when you get good probability, you place a bet, right? But whether you'll still win or not is not known. A low probability event can also occur and you can lose money. I think similarly in investing, when you're buying, you are based on whatever your elements of probability, one, at that point of time, and secondly, how the future changes will determine whether it'll be a good investment or not. And you have to sort of follow that aspect, both from the standpoint of how the external things are changing, and secondly, in terms of what you thought initially or your framework, so compared to what you thought and how things actually are. So one has
So
to
one has to
evaluate that.
evaluate. So, more of the question, if I assume I understood it correctly. So basically, he's talking about, say, if we talk about the concept buy and hold, right? So there
Yeah.
are times when you saw big drawdowns, and there are talks about like opportunity cost, right? At times we
Right.
are too early in the investments, right? So
Right.
how you view this? Because like you believe that the investment should be buy hold kind of, or in today's time, since like things are comparatively changed, if you talk about the market inefficiencies are comparative less if you compare 10-20 years ago, right? So how you view this?
See, again, it's uh, so when you sort of think deeply about it. So one is how 30, 40 years the markets were, let's say in India, inefficiencies were far more, because you did not have information, you did not even have annual report. Today you have everything. But going forward in the next 30 years, you'll have exponentially more opportunities to make money and far more money, right? So the best time is yet to come. And the simple example of that is, even if you means one is like intuitively one can understand that, but even as an example, you look at US markets are, they have a history of 100 years. They're far more developed than us. And even in the last 23 years, look at the wealth that has been created there, right? In those efficient markets. So opportunities are and will always be there. Obviously, there could be a market environment over a short period of time in which it could be challenging. But from a 10-year, 15, 20-year perspective, I don't think so. There should even be an iota of doubt about the opportunity. That's one. Secondly, is I think partly because it seems simple and easy to sort of understand, and a lot of I think people also talk about it. But simple things are just not simple. See, buying and hold, yes, but in what context? So depends on what you are buying and holding. Not everything you can buy and hold. So I guess the biggest example for this is I would genuinely suggest anyone who has interest in reading to read the book Battle for Investment Survival by Gerald Loeb. It was written in 1935, right? Almost 90 years back. And largely what you hear in the financial media now, what you sort of listen on Twitter, what people talk about, it's largely he wrote back in 1935 and the other books also, but 90 years back. So nothing's changed. There's nothing new about being positive and then buying and holding. Yes, but the context has to be that while India will grow, and that is what he wrote in 1935 about America, that while America will grow even after its setbacks and it will go to new heights, but at the same time, not all companies and industries will grow. So, holding on to something which you should not be holding on to, thinking about India growing, is very different thing. So 20 years down the line, will India grow? The economy will be better. We'll have higher per capita. Yes, but whether a particular industry or a particular company, by that logic, will also do well, there's a question mark around that, because those are very different things, and that is one needs to where one needs to think about when we are talking about buying and holding for long term. That what are you buying and holding and why, and what is the risk there? Yeah.
Right. So, Arjun, you can unmute and ask your question. Arjun, you are still muted. You unmute and you can ask your question. Okay. Growth cap Guru. Meanwhile, you can unmute and you can ask.
Thanks, Prince, for accepting my the invites as a speaker. Saurabh, good evening, and all of you, very good evening. Just wanted to understand how you basically look the market from here. I mean, basically into the small cap companies. Yeah,
Okay. Good
the
evening.
valuation. Yeah.
See, so again, from a broad standpoint, difficult, because again, if you ask me broadly, from a risk reward standpoint, when valuations are already high, now I guess it's more difficult to make money until unless there's higher growth, or until unless the valuations continue to go up, right? It's as simple as that. So if a certain thing is trading at a higher multiple, for to make money on that, either the growth has to be stronger or the multiple continues to increase, right? So you have to take a call based on what you're looking at and sort of what you think from a growth or multiple standpoint where it can grow and why. Uh, Second is that in a bull market, while it is very easy to make money on small caps, right? Small caps, or rather illiquid names, because obviously any bit of liquidity will make them go up, and sort of it seems one is making a lot of money. But at the same time, one should rather do the opposite. In a bull market, depending on where you think it can go, get your portfolio into better quality businesses, and if you can't really find anything, maybe cash. Again, see, again, it is a function of what is your time frame. Let's say if your time frame is long term, so you can still have the ability to sit out of the markets in cash and wait for a good opportunity. And also how your temperament is, because if things are going up, right, and you get FOMO, then it's the worst. Then it is better not to sell and just continue to be invested, because otherwise you will sell and then get into the market at a much higher price and lose more money. So depending on the temperament, depending on sort of how one looks at it, is a function. And maybe to answer, give you my personal perspective, I think there are still opportunities available, but at the same time, finding good quality businesses at reasonable valuations is a challenge, right? So either it's a question of digging more deeper, sort of, and taking very, very specific bets, but largely at the market level, yeah, it's difficult to sort of get investments where you get sort of lopsided risk reward.
What I see personally that all the companies which are into the growth, I mean, uh, having the very good growth futures, some of the sectors as well. But I see there are lots of companies into that sector who is going to perform well into the coming couple of years. Basically, that having the very high P. I mean, valuation is like very high for those company, even though we can't think of entering because if any corrections happens, that probably is going to fall down because. Uh, I mean, companies can never trade, I mean, into overvaluations. So into this bull market, basically, I see all those sectors. I mean, defense sectors, heavy sectors, or sustainability, and some other sectors which are doing good. Defense sectors, so they are doing good because they are having the good orders, and but their valuation is very high. So it is advisable, or it is good to make the positions even though the valuation is very high. But considering again having the very good growth, I mean having good book orders and having great results and every quarter and those sort of things, it is advisable for this time to invest into those companies.
See, again, it comes down to the individual that is investing. I can give you the pros and cons of investing in those kind of companies. So, one is, let's say, if those companies continue to grow, or if they are growing at a, let's say, 30-40%, and they can grow at 30-40% over the next few years, maybe you can still make money on them. But if they can't grow and interim something happens, obviously there's a high probability the valuations will correct. So, whether to invest or not, one has to take a view on this. So without taking a view on it, it's very difficult, right? Because someone who takes a view that the growth will continue and it continues, there's a high probability he'll make money. And if it doesn't continue and anything happens, then obviously there's a whatever downside to it. So it comes down to your own understanding, your own conviction around it. That what do you surmise of that?
Maybe you there?
Hello, am I audible?
Yeah.
Hey, Prince, thank you so much for arranging this space with Saurabh uh, and giving me an opportunity. So, Saurabh, just want to appreciate and really thank you for writing this book, and even more thank you. I was in Germany when actually COVID hit, and you were kind enough to send this book across right through India to here, and I thoroughly enjoyed it. So thank you so much. I hope you also come up with a volume two and a Kindle version probably. I have a question for you, Saurabh, from your interaction, your own investment experience, and your interaction with all these big super investors. You might have already noticed if we go a decade back and if we look at today's time frame, the cycles have shortened, maybe because of the pace of the information flow uh, and access to the information probably. So a lot starts getting factored into a price a lot ahead in time, right? Uh, that said, businesses and the companies can still be very good. So what is that one framework that investors can follow that will allow them to either hold those businesses even when so much is there already in the price, but you already know that no, this business is something that's gonna you know probably will stay overvalued or stretched over a period of 3-4 years down the line. But after that, again, the business is very good and there is still, pretty good amount of alpha available to generate. Or maybe any pointers in that case where, you should take some money off the table. So how would you maybe navigate through such dilemma? Thank you.
Yeah, thanks. Great to know that you enjoyed the book. See, again, the challenge comes, and I get sort of what you are asking, but see, the answers are not as simple, right? Because again, there are too many things around it. Like investing is easy but not simple, okay? So to answer your question, now let's say if I have to, I sort of answer it. The couple of things I need to understand before answering it is, because the context of that answer will depend upon these things, is so someone who's investing and asking this question, whether his investment is based on flow or stock, right? Which means you have a certain amount of money on which you cannot add more money, and that is the only money that you need to sort of compound, versus you have a certain amount of money now and you also getting cash flows over the next, let's say, again, the time frame is another aspect, over whatever time frame, and you can continue to invest. Now those two things make a lot of difference, because if someone has a stock, certain stock, no more money, then he has to maybe more disciplined in terms of making sure that he doesn't lose much, or when opportunities really come, he has some money to invest, right, from his own corpus, this existing
Right.
corpus. While
Mm-hmm.
someone who has a flow coming in can be more flexible, right? So again, this is just an example, and also in terms of the time frame. Third is also in terms of what is the objective. Now there are people whose objective is to beat inflation, right? That is very different. And there are people whose objective is to maybe maximize returns, again a very different thing. Okay, so again the idea about saying is that in terms of, while having a discussion is it becomes challenging to answer sort of in a generic way, because again my answer could depend upon how each of these things are. Okay,
Right.
so but I'll
Right.
still try to sort of take a shot at answering in terms of, let's say, the context that I can see it is. Yes, cycles have shortened, but at the same time, now you get an opportunity wherein if you find something or you can invest in something where the risk reward is good, to make money quickly, right? You don't have to wait for a long
Mm.
period of time. So that is the advantage of that. Second is, given how the cycles have shortened, there are extreme reactions to adverse events or bad news also, which again gives you an opportunity to maybe buy, right?
Mm-hmm.
So, yeah, it has shortened from the standpoint of that information availability is now more sort of democratized, which is good. Uh, but from the standpoint of opportunities, I think it's a great time still, because the information earlier means people had sort of privileged access. A normal investor could not really get information. Today, you look at, means it's largely you can do most of the work without going anywhere or meeting anyone, right? That much
Right.
information largely is available, right? Who would have thought so? uh, so that is sort of broadly another thing on that. And sorry if I've missed any part of the question, if you can repeat that.
No, no, fair enough, Saurabh. Get the gist. But thank you so much once again.
Right,
Right.
thanks.
Thanks. Thanks, Amir. So, Saurabh, like, obviously, not about names of any particular company, but again, if you have to invest today, so which pockets you will be positively looking at?
So see, means in terms of again where I sort of see opportunities, or means my understanding, right? I don't understand a lot of things, so I'm not saying the opportunity is not there. Means it's sort of because I don't understand them, right? So that's sort of on me. Where I sort of see opportunities, I think agro space is one. I think financials are reasonable, but again, one has to be sort of selective there. Uh, again again, I can't go really industry wide. I think it comes down to company, and more importantly also it comes down to, because see, initially you could invest in 10 things, again from a framework standpoint. So if you invest in 10 things or 12 things, you also have to sort of pivot based on how things change, right? Because you'll invest thinking something, but in the future things will change. So you have to put more money behind what is working and take money out from where it is not working, right? So I think from a framework standpoint, for me, means I do that. I'm not saying everyone needs to do that. Again, it comes down to, from an average return also it could be good for people, but because at the outset one is investing, one doesn't know how it will fare out, right? You just have probabilities, and then you sort of change your portfolio positioning and position sizing based on sort of actually how things are happening, obviously means within the framework of the risk reward.
So coming to the definition of risk, like how you define risk and what all measures you take. Like if I talk about for, I mean, obviously when it comes to managing public money, there are certain restrictions again. So but more or less, the risk management is comparatively same. So or you see any segregation in that?
See, the risk here is when I say risk is risk of losing money and the risk of not making money, right? There are two risks that you'll invest into something and you lose what you lose, whether you lose 10%, 20%, 50%, right? So that's based on sort of some assumptions, sort of some understanding. That is that particular risk. And second risk is that I'll invest into something and let's say in the next 2, 3 years, I will not make any money. So when I say risk, to me, these are two risks that are there.
Right. And so, what all I mean, you keep in mind, or maybe the inculcate in your framework so as to manage these two risks.
See, I guess one is to focus on the key aspects, right? A lot of things are unknowable, means after a certain point of time, trying to do more work, trying to find more things. Again, I'm talking about myself. I'm not saying that is the only way. For me, it does not add value, right? It's like the 80-20 principle. So to focus on the 20%, which will define the 80%, and that's more important. Uh, so I think largely once you have a handle on that, and secondly, obviously in terms of margin of safety, you want that let's say if you can potentially lose X, then you should be making whatever X plus Y plus Z, right? If things go right, uh, because otherwise it's like if I can lose X and I can make X only, means then there's no advantage.
So we got one more speaker, Jadip. You can unmute and ask your question. Jadip, you are still on mute.
हाँ सर, आवाज आ रहा है?
हाँ
आ
जी
रहा है.
सर मेरा एक इन्वेस्टमेंट रिलेटेड क्वेरी था.
ओके
में है, तो मुझे हर मंथ
सॉरी जयदीप योर
50,000 रुपए
वॉइस इज
डलवाना.
ब्रेकिंग
जयदीप,
अरे
आपकी आवाज कट रही है और मैं आपके बोलने से पहले एक छोटी सी बात कहूंगा कि स्टॉक स्पेसिफिक अगर क्वेश्चन रहेगा तो रियली सॉरी, वी वोंट बी एबल टू टेक
नहीं नहीं,
दैट.
स्टॉक स्पेसिफिक नहीं है.
जी बोलिए.
हाँ, अभी आवाज आ रहा है सर.
हाँ जी
तो मैं एक टैक्स सेवर फंड में इन्वेस्ट करता हूँ, तो उसका जो अमाउंट है वो मेरे सेविंग में है. तो सेविंग में उसका रिटर्न, सेविंग के बैंक का रिटर्न कम आता है. तो हर महीने को उसमें बैंक में से इसमें डीमैट में लेके फंड में इन्वेस्ट करता हूँ. तो सेविंग में रखने से अच्छा किसी कोई दूसरा ऑप्शन है क्या जिसमें इंटरेस्ट रेट का बेनिफिट ज्यादा मिलेगा मेरे को?
सी वो मतलब अगेन सेविंग के कहीं भी आप और इन्वेस्ट करेंगे तो आपको देखना है उसमें रिस्क क्या है, राइट? सेविंग अकाउंट में द ओनली थिंग आई कैन मतलब सेविंग से ज़्यादा इंटरेस्ट मिलेगा बैंक एफडी में. और इक्विटीज़ में इन्वेस्ट करेंगे तो आपका क्या टाइम फ्रेम है, कितने टाइम के लिए इन्वेस्ट कर रहे हो, कहाँ कर रहे हो, तो उस पर डिपेंड करेगा.
अच्छा ठीक है. नहीं, भारत बॉन्ड या ऐसे कोई दूसरा इंस्ट्रूमेंट है जिसमें पैसे रख सकते हैं?
सॉरी यार, देखो स्पेसिफिक नहीं बोल पाएंगे. जैसा अभी सौरभ ने बताया कि आप एक बार थोड़ा इवेल्युएट कर सकते हैं कि आपको कितना पैसा लगाना है, उसका टाइम होराइजन क्या है और क्या क्या आपके पास ऑप्शनैलिटीज हैं. तो थोड़ा उसको आपको इंडिविजुअल लेवल पे करना पड़ेगा, या कोई आप अपने फाइनेंशियल एडवाइजर की राय ले सकते हैं. पब्लिक फोरम में वेरी सॉरी, क्योंकि हम अपना एक ओपिनियन दें और उसको सुनने वाले में भी हो सकता है गलत तरीके से लें, तो वो कंड्यूसिव नहीं है. तो रियली सॉरी फॉर दैट. So coming
नो
to
प्रॉब्लम
next
सर,
question.
थैंक यू फॉर योर टाइम.
Thanks brother. So Saurabh, coming to next question. So when selling a position, I mean selling a company is always a pain area, right? Because I've seen, like, and I personally feel Same, and it is like within the network also. When I talk to people, they also most of the time suffer, and like most of the time people feel like they sold early, and it is full of regrets. But again, one can be like have some set strategy for selling a position. So do you have any, or it also like it's a variable thing for you also?
No, I have sort of a framework for myself, but again, before that, I just need to definitely say that everyone, as an investor, you one have to figure out your own framework, right? And again, two very important things there. One, you cannot, or no one can do everything, right? Means that all sort of sectors, anything which is going up, matlab, do value also, do growth also, do momentum also, do mix of all those also, do small cap also. At different points of time, different things in the market will be going up and down. So if you are just trying to do whatever is happening in the market, you are behind the market. I think it's a very difficult place to be in, right? And very difficult to be successful that way. So you have to step aside and see independently. You have to think independently, have an independent framework. Obviously, means you can learn from others. You can books your own experience, other people who you think are good, and sort of, so all that you can use, but you have to be independent. You cannot invest on borrowed conviction, right? Because one, you will not be able to do what the other person is doing, and you do not know whosoever is saying or doing whatever they are doing, what is their thinking and their own circumstances, right? So I think independent thinking very important, and secondly, you cannot do everything, so you have to focus on whatever that one can do. So in that context, in terms of how I look at selling, is that. So when I'm investing into stocks or companies, so there is a certain thesis, and with time one sees whether that is playing out or not. Again, one very difficult thing is that when things are not happening, but at the same time there is still hope or stocks are not falling, so that actually leads to your compounding getting killed because the stock is not going anywhere and it pulls down the portfolio. So again, there is nothing right or wrong about it, but the challenge comes that the mental model becomes that, let's say if I'll sell, it'll go up, right? Now with that sort of a thing, again, it is very difficult because it's like you have to have a framework and whatever comes with that, right? Because if you don't have that discipline to take difficult calls, it will become difficult to improve. So it's like when you buy insurance, you still pay a cost. Now you cannot say because I'm paying a cost, an accident should happen, I don't want to lose money on the premium. So similarly, the difficult decisions in terms of maybe related to selling has to be seen in a way that you are paying for insurance, and after that, if it sort of, so let's say means for me it will be, if a stock is overvalued and I'm selling it, right? To my mind, means the risk reward is not favorable. I'm selling it, and it continues to go up and make a lot of continues to go up a lot. Now, until from a fundamental standpoint, something I missed, that is a learning for me, and I should take that as a learning. But if it is nothing and it just went up because whatever market went up, or let's say the stock wasn't fancy, the sector wasn't fancy, whoever was buying it, that's just part and parcel. That should not that should be fine, not bother me.
And
And again, a lot of things happen from our own experience. I think even from the book. I think Mr. Rajshekar Iyer there. So his learning in the first cycle was because he bought stuff, sold it, made some money, but he could have made far more money if he had held on to it, right? So from his personal experience, in the next cycle, he did the same thing, that he bought but did not sell this time, because in the first cycle his experience was if you hold, you make a lot of money. So what worked in the first cycle did not work in the second cycle. Stocks went down a lot, he did not make money. So again, whether you have to hold for long term or sort of take money off the table, you have to incorporate in your framework based on how you are investing. uh, Largely, there are some stocks which I'm okay holding on to, provided my return filters or the money that I intend to make on them from a compounding standpoint is fine. And also, it depends upon the quality of the business. And where I think the stocks are overvalued, but let's say the momentum could be there, I sort of still can hold them, but I'll be very nimble in terms of selling them. So it is just trying to sort of extract more as an option, but again, not lose money because of that. Right? So one has to be very disciplined that one does not allow the hope value to come in, and one is disciplined about sort of selling there. And I think again in investing, it is a lot to do with sort of hope, which gets a lot of people into trouble. Hope, and secondly, the what do you call wanting to be right, right? So you buy something thinking something, but even though it is not happening because you thought so, so you continue sticking with that, and again that's sort of counterproductive.
So, Saurabh, you were talking about keeping cash. So, like, if I were to ask you, like, say, at some point in time, you get incremental cash from your clients, and you do not find any good opportunity. So, is there any obviously you can't keep holding cash for a very long time, right? So, what do you do in those situations?
See, first thing is, let's say, depending on kind of people that you work with. So if you have clients who also have a longer term horizon, when I say long term, because I think the idea about investing in equity should be to create wealth over a longer period of time. So there should not be any problem even holding cash for a long period of time from a principally, right? Because if you have no opportunities, you should not be investing, right? Second is, now can there be a situation wherein there'll be no opportunities over the next 2 3 years? I think the probability is very low. Maybe over the next 1 or 2 months, 3 months, no great opportunity, fine. Maybe 6 months, fine. So as you increase the time frame, the probability that you'll get opportunities to invest increases. So I think from a mental model standpoint, if you say, I need to invest this money over the next 1 or 2 years, right? Not over the 1 or 2 months. I think, and obviously you need to be good enough that when the opportunity comes, you are investing, right? So with that, you're not sort of you don't have any compulsion to invest when you're not getting opportunities.
Right. So, Saurabh, if we talk about China plus one thing, so how much of potential you see, and how much of that concept of China plus one is already in price, maybe across sectors? Because from COVID onwards, we have been China plus had been the buzzword, and every company is like pushing China plus one. So on ground, do you see it materializing big time, or it's a far distant dream, which because China replacing China in manufacturing is indeed a very tough task, right?
So I really wouldn't have the expertise to answer that question. So largely, I look at companies, and most of the companies, let's say I am invested in, or sort of looking at it, the China aspect is limited, and I personally means because of that haven't really done too much work around it, so I wouldn't really be able to comment. Or sort of, I really don't have any deep insights on that.
So, is it fair to assume that you do not focus much on macros, or it would be a wrong assumption?
Largely, it's true. So, because let's say largely for me it'll be bottoms up, and yeah.
So, which two, three things, although like you touched upon, so which mistakes to avoid in a bull phase of the market? FOMO is one. What else we can look for?
See, in a bull phase, making money becomes easy, but the thing is, you should know what you are holding, and secondly, when you need to sell, because if you end up holding shitty stocks, bad companies, small companies which are just going up, let's say business is not strong vis-a-vis what you're paying for it, then whenever it turns, you'll be left holding it without being able to sell. So that is one, right? So again, it depends upon what you're holding, because again, the easiest money in a bull sort of, at least the late stage of the bull market, is made in the weakest stocks, because the good quality companies sort of which everyone wants to buy go up first, and then sort of all the bottom stuff moves.
Second is,
Second is, hello,
yeah, please go ahead.
right? And second is again means one needs to improve the quality of the portfolio. So let's say if you have made money, let's say with skill, luck, or a mix of those in a bull market, then you need to constantly see that how means in the kind of companies that you are invested in, one, are they getting better, right? Because see, a big company earning 15% ROE versus a small business earning those kind of ROEs, while it is fine, but let's say in a downturn, the bigger company will be much less impacted and a smaller company will be far more impacted, right? So again, one has to look at how the portfolio is there, how it will be impacted sort of in a bearish market, or when sort of from an economic standpoint things become challenging. And see, again, means I really can't say how to time the market overall at all points of time, but definitely at turning points. Again, part of the book, a lot of people have talked about it. It's not an exact science, but when shit moves a lot, when making money becomes easy, sort of. Let's say even from a media standpoint, when everyone's talking bullish, so those are the kind of things, right? But again, it's not that if everyone is doing it, definitely it'll be the end of the bull market. So it is again probability pointers, right? And the bigger advantage for a small investor is that he can be very nimble. You can sell large part of your portfolio today, and even if you're wrong tomorrow, you can still buy it back, right? And still make money, or vice versa. But let's say someone with very large positions cannot do that. They just cannot buy and sell, or sell and buy back easily. So that's an advantage. So it's again, broadly speaking, that you have to see how your portfolio is, how your view is on the growth aspect and sort of the risk aspects of the business.
So sort of like cutting down on the losers is a very good aspect which everybody should look seriously in the market. So I mean, if we talk about like when it comes to investing public money, and say if you have invested in some company, and how much time do you give for any investment, in the sense like obviously it happens all the time that there are some investments which go bad. So, like, how much time do you give before like cutting down your position because the things haven't worked the way initially the thought process was before investing?
See, again, it depends. Let's say why they haven't worked. So, let's say if something has happened which initially wasn't there in the business, then even in a short period of time, one can cut it. But if it is that something is taking longer and you have better opportunities available, that you want to move to a better opportunity, then, and at times, obviously, it backfires also. You sell something and after that only it goes up, but that's part and parcel. So, again, there is no specific time per se, but let's say when you are investing at least from a 2 to 3 year standpoint, right? You're not investing from a very short term standpoint also. And I think personally for me, I'm not also investing right now from a 10-year standpoint, thinking 10 or 15 years out, while I'm investing from a 3 4 year standpoint. And I can continue to evaluate things, let's say on a 1 2 year basis, and could still continue to hold that thing for a 10-year period. But again, from my framework standpoint, I guess it's very difficult to look 10 years out and sort of invest today. Uh, so again, it's not for me there.
And sort of client onboarding is a very important aspect, like because taking money from everyone doesn't work, in the sense because you cannot control the temperament of the client. So how had been your experience when it comes to client onboarding? I mean, do you like are there any filtration criterias, or how it go about at your PMS?
So I think again it's a function of, let's say, how your thought process is, whether it matches the people that you work with. If it matches, I think that's the best thing. But let's say if there is a difference there in terms of how you think, how you are investing versus the expectations of any uh, potential client, and sort of, then it is better not to sort of work wherein the mismatch is there. And I think the only way that you can do it, be transparent about how what you are doing, how you are doing, and what are the sort of both pros and cons around it. And sort of, because once you're transparent, then obviously people who don't sort of match it, or for them this is what they're not looking for, so it's easier, right? So And I definitely, in terms of the kind of people that you work with, has a very important bearing on how the whole investing experience, or let's say your professional journey, is.
Sir, when it comes to successful people, there are common traits. Obviously, every individual is different, but there are certain qualities which are common. So, if I talk specifically about the financial markets, see the 11 people which are there in the book, whom you guys have interviewed. So, any two, three qualities which were common to all of them, and you think is indeed very, very what we say needed for any person to be a successful investor.
Yeah, I think quite a few. So definitely one is that you need to, in investing, read a lot. And more importantly, actually, I think when you're starting out, read yourself and make independent judgment. So let's say means, see, one, there are no experts, right? Means, again, let's say listening something from someone, obviously you can learn, but you cannot take what the person is saying will happen. It's probability. Okay. And because you're starting new, you might not know. So today means if 500 people are talking about investing, I don't know, maybe 50 or maybe 90% of them don't know what they're talking about. So for a relatively new person getting into investing, he cannot differentiate between who's talking sense, who's not talking sense. So I think for him, it'll be better to actually also go and look at the primary sources of data and see for himself and gradually build up on that skill. And it's very, very important. In terms of people who've been very successful, one common thing is they read a lot across, because you need to know things for yourself. And the only way that you can do is you actually need to sort of know things for yourself. Second is independent thinking, and sort of again, I think these are two, sort of, to my mind, the most important things, that you read a lot, independent thinking, and obviously build a framework, be disciplined about whatever, howsoever you are doing. So again, different people, different things. Like you can build a journal in terms of when you are investing, write about that why you are investing, because over time you'll realize that what you initially thought versus what initially happened. So all these things help your own learning to make you become better on a sort of incremental day-to-day basis.
Right. And obviously, like asking one particular name who is favorite is not a right question to ask. But again, we can like put the question in a manner like, who you think your framework is inspired the most from the people you have interviewed?
Uh, Difficult question, because again, it's a, see, it's like you take what works for you from wherever you can take it, right? So, from that particular standpoint, I think before we wrote the book, for me personally, uh, from the standpoint of how to look at selling, right? I think Raj Shekhar interview did sort of really help a lot. So definitely, I think that was there, and a lot of other things also. Means I think in terms of, I can talk about it a lot. So what I took from whom and how. So that'll be never ending. We can't sort of do that
Sort
in
of do
one
that in
session.
one question. Right, understandable. So, Saurabh, you also mentor people and even the family offices. So, how had been your experience? Because, like, when we mentor, and obviously, when you have good set of student or say, I mean, learners rather. So, we also learn when we teach people or maybe acquaint them to our framework. So, how had been your experience, and what are the focus areas when you mentor people?
See, it's not about when we say, let's say, mentor or work with people. So, at least from an investing standpoint, it is not about that there is the right thing to do and sort of you teach people, okay, this is right, you do it. Uh, so, it's like more about sort of working with them in terms of how to think for themselves independently. Okay. And more so in terms of accelerating the process. A person can still do it, but something that will take a person maybe couple of years at his own pace with his own sort of ups and downs, you can accelerate the whole process, shorten the learning period. So I think that is where the value add is. It is not about, okay, fine, because their own process, their own framework, they will learn, improve over a period of time, they'll be good at it, right? But in terms of how to sort of get to that, to shorten that sort of is the work.
Like, how had been your experience investing in the cyclicals? If you and like any big mistakes or big winners from the past you want to talk about?
From a cyclical standpoint, so it's been average. I don't think so. We've made a lot of money on any cyclical per se. So I think brokerage stocks post COVID not there anymore in the portfolio or with me. So that was one. But so largely been sort of I haven't so maybe some cement stocks and all, but nothing sort of as sort of very big, I would say.
And apart from cyclicals?
See, again, largely, I think I'll refrain from talking on over from a stock specific standpoint. But again, it comes down to where you can see outsized risk reward from the standpoint of where you think you can, if you're wrong, you would not lose much. But if you're right, you can make a lot of money. I think that's the starting point. And then you have to also ascribe or think about that for you to be right, what will it take, right, in terms of the probability. So
So
again, it comes down to the upside versus downside, all and the probability of getting that upside or not.
So, sort of like PSU stocks from the past 1 2 years, I have been doing good, and down the line also the current government appears to be optimistic about the sector. Even the PM Modi today was speaking. He was taking a dig at the opposition. Jokes apart. So, do you think something has changed materially in the PSU space, or how you see that space, and if ever like you see that as an investable space?
We have invested in PSUs, made money also. Uh, See, but again, the thing is that end of the day, a PSU has the element of that government thing, right? So again, you have to take a view in terms of what is the risk reward. So let's say if you're getting a PSU extremely cheap and with some catalyst where things will change and you can make money is a very different thing from buying PSUs at the same valuation like a private company because they're always or there should logically be a discount because of the government ownership. How a private company on a like to like basis, how a private company will be run, right? A PSU cannot be run like that on a like to like basis. So again, from a conceptual standpoint.
Right. So obviously, apart from your book, and I mean that's a very good book, beyond doubt. I myself have enjoyed reading it, and all the time, like I can start with any chapter. Any other books which are very close to you and have benefited you a lot in your in developing your thought process related to financial markets?
Actually, quite a lot of books. So let me see.
And meanwhile, for our attendees, like last 5 10 minutes, if you have any questions, that's Saurabh, and you can also type in the comments. Yes, Saurabh.
See, some of the books that I really like. So, Battle for Investment Survival, I did mention, right? Uh, then there is a. Sorry, so, how I made $2 million, I think. How I made 2 million. That's by. I forgot the author right now. 1 second. Think it right. Zebra in a Line Country. That's another book. Very good. There are a couple of books by Mark Minervini. Again, he's sort of a trader focusing on breakouts, but again, purely from the standpoint of if someone has to look at sort of technical or understand that particular part of the market from a psychology standpoint, I did find it good. Sort of, again, it helps to increase your circle of understanding. And beyond that, Mark Douglas. Uh, Mark Douglas's book. One second, just forgetting the name. So that was another one which was really good. I'll just
I'll
tell
just
you. Nothing of
nothing
forgetting
of
it.
forgetting it. So
Tweet maybe after the space. So Saurabh, you talked about technicals, right? So does technicals find any space in your framework, or is it be it before buying a position or maybe during selling?
See, yes, means I do look at technicals, but from a very basic standpoint. So it is just trying to time the buying and selling better. But again, largely it will be fundamental, and it's more about controlling the sort of, let's say, down means basically trying to get the entry better. Uh, yeah. But
And
again, it
Saurabh,
can
again,
work
it can work.
both ways, right? Means when you try to do that, it can at times backfire also. So again, one has to be cognizant of that. By the way, the name of the book is Trading in the Zone by Mark Douglas. So that's another book that I really like.
so although valuation in itself is a very broad topic, and saying in few lines and words won't do justice. But again, broadly, any sense on valuation in your, I mean, how you value companies?
See, again, it helps if you can keep it very simple because see something where what you understand, you should be able to articulate it in a very simple fashion. Obviously, I mean there'll be caveats and everything risks, but the whole logic of it can be very very simple. If it becomes too complicated and sort of you have to sort of convince yourself only through multiple different arguments here and there, means it sort of that is sort of a flag for yourself that okay fine, it's better to avoid it unless you can have a very simple sort of thought. Because the thing is, see, as things change, if you don't have that simple thesis in your head, you sort of will get confused or sort of yourself sort of complicated complicate the whole thing.
Right. So we have one speaker, NSW. So you can unmute and ask your question. NS Vargade, you're still on mute. If you have any question, you can unmute and ask your question. Hello. I think there is some issue on his part. So, sort of anything which maybe I forgot asking you and you had in your mind so as to discuss with our attendees. Anything you want to say?
Yeah, I think largely, I think to summarize, I'll say that investing is a means if done right, right, it's extremely rewarding. Means among other things, and if you enjoy it, it can be a great thing because obviously it's rewarding. It can be rewarding financially and something that you enjoy. But at the same time, one needs to be cognizant that it won't be easy. And secondly, without independent thinking and work on your own part, with sort of listening to people only because someone's saying something and making sense to you, fine. But unless you actually go down, do the work yourself, and make sure, because see, from a primary, from a data, right, let's say from data from the annual report or the primary sources, now five people can have five different interpretations to that. And when five, and it'll all sound logical, right? But we all will listen to those five people and agree, disagree, like, not like, based on how we find that. Versus till the time you don't actually go do the work yourself, you won't be able to understand different nuances around it. And there are means it's not simple that okay fine this will happen and that will happen. It's probability and other things can also happen. So what I'm trying to say is that everyone needs to do the work, because it takes time to be able to understand these things. And I'm talking from my experience also. It's taken almost a decade, at least initially, to understand what one was doing wrong. Because initially, the simple things, logical things, they sound so appealing because they are simple and logical. But at time, but in markets, not everything is simple and logical. Means things go to one extreme, then other extreme. Companies which look cheap are value traps. Companies which trade expensive create a lot of wealth over time, right? So these things are like against common sense, but that's how things happen, or how things also happen, right? Commonsensical things also happen. So that's what I'm trying to say, that you have to do the work. And today, I think the advantage is you have so much information, so much data that is easily, freely available. And so, yeah, great time.
So we got Anas again. Let's see if he's able to speak. So Anas, you can unmute and ask your question. Anas. Anyways, so Saurabh, before we close, I thank you for taking out the time and sharing your insights with us, and it was a great session listening from you. And one last question, obviously when we interview someone, so obviously it takes a lot of effort so as to do homework around the framework of that person. So how had been your experience on that front?
In terms of, sorry,
I mean, what you used to do, say, if you have to interview someone, so what's the homework that goes behind before going for an interview with that person?
so I guess one obviously will be I'll try to understand the background of the person, and generally see in terms of when we are investing, or let's say if you invest, you understand now there are challenges, right? So let's say it's like people talk about buying and holding from a simple standpoint. So people who have had the experience, to ask them that how have they navigated this thing, how sort of their thought process developed, and what they are doing now is why. Means if someone says that I don't look at cyclicals, right now, why? And he could have an answer, and that's fine. And similarly, if someone says that, okay, fine, I focus on these three or four areas, which is also fine. Not that maybe that's the best way, but that suits his temperament, right? And now at times there are some generic questions in terms of the learnings that people would have had, because again, it's like a lot of times you understand that you can learn vicariously, right? Means you don't need to do all that stupid things yourself. Like an example is, let's say when you look at people look at stocks. Now someone could have a framework wherein they say, I'm investing in stocks from the standpoint of that I don't think so there's much to lose, right? I won't lose much money. But they have no idea about how they'll make money. But they might make a lot of money because either they could be lucky or whatever the market environment. Now, that works for them, but one has to then think that whether that works for you or anyone else or not. So I think one can have sort of broad, open-ended questions about largely the challenges or things in terms of investing, and sort of take it from there.
Great, thanks. That is really valuable for me so as to inculcate in my questions down the line. So thank you so much, Saurabh. It was indeed great having you today, and thanks for our attendees for listening for so long. And those who joined late or maybe coming to my spaces for the first time, they can surely subscribe to my YouTube channel, that is Accidental Investor Prince, because I upload all the podcast over that. So you do not miss out on any of the insights shared by the expert which we invite. So Saurabh, thank you so much, and yeah.
All right, thanks. My pleasure. I hope it has been helpful. And
Surely, it is great help, and surely those who couldn't attend live, they will listen to the insights, and surely will like to have you sometime down the line for another great session. Thank you so much.
Sure. Okay.
Good night,
Thank
everyone.
you. Good night. Bye.